themselves. However, if you're more interested in a potentially less expensive option that allows you to support your family with an income stream while simultaneously covering your mortgage, you should consider term. The advantages and disadvantages of mortgage protection versus term life insurance. Without a doubt, the COVID-19 pandemic flipped the globe on its head. Stocks dropped, entire businesses collapsed, and many young professionals, no longer able to enjoy $20 brunch specials, opted for mortgages instead of memes as well, kind of. The commencement of the pandemic coincided with record low mortgage interest rates. In addition, because remote working possibilities made city life less required in 2020, housing demand soared. And while it's great that those of us who previously couldn't get on the property ladder now have a foot on the first rung, it's crucial to realize that owning a home is a whole different animal than renting one. Seriously, as a homeowner or soon-to-be homeowner, have you thought about how you would safeguard your family from frightening mortgage payments and general financial strain in the event of your death? It just depends on the type of insurance you have, so don't worry if you haven't yet. And here's a hint. It's not the type you would expect. Why do I need mortgage protection? Owning a home is a major accomplishment. Consider that your home is likely your family's most valuable asset, as well as the source of your largest monthly payment. We presume that, as a responsible homeowner, you have taken the necessary precautions to safeguard your home from fire, flood, etc. However, have you ever pondered what would happen to your home in the event of your death? Not to repeat the obvious, but you must preserve your mortgage so that your family inherits your home in the event of your untimely death. Suppose you share a mortgage with your spouse. If the unthinkable were to occur, would your spouse be able to cover your portion of the mortgage and continue making payments? Assuming that they are not a parent who stays at home, no spouse or kids. Then, what about a co-signer? If you've enlisted your parents' support to purchase your ideal home, consider whether they'd be able to shoulder the financial strain of covering the mortgage if you died. It's true that while we often have a plethora of precautions in place to protect our assets from would-be criminals during our lifetimes, many of us don't give the same consideration to how these assets would be handled after we die. How therefore can you safeguard yourself, your family, and your residence? This is where insurance comes in, then. You have options ranging from mortgage protection insurance to life insurance for your mortgage. Read on as we discuss the distinctions between the two and outline the positive, negative, and downright ugly aspects of each. Just kidding, there are only positive pros and negative cons. The advantages and disadvantages of mortgage protection insurance. Mortgage protection insurance is a form of mortgage life insurance that pays off your mortgage in the event of your untimely death. This should not be confused with private mortgage life insurance (PMI), which covers the Bancorp lender if you fail to make payments. So, after purchasing your first home, you probably began receiving flyers from a variety of insurance firms stating, "Protect your property with mortgage protection insurance." And I'm sure they all state immediate action required, right? It's natural if you've been tempted to join up for one of these policies. After all, a glossy, well-designed leaflet in your mailbox is likely to appear more credible than the classic shady insurance salesperson who calls you out of the blue. But before signing up for any of these convenient insurance, you should be aware of their advantages and disadvantages. Pros. Mortgage protection insurance eliminates uncertainty about how much you still owe on your home. You can see how this would be handy at a time when your loved ones are probably stressed enough without having to crunch any numbers. It's tied to your remaining mortgage debt, so you don't have to worry about a lack of funds in the event of your untimely death. If you have a health problem that fully or financially disqualifies you from obtaining life insurance for a mortgage, we'll discuss this next. Mortgage protection insurance will cover you. Typically, you can avoid the underwriting procedure and obtain coverage for a price that is likely less than the alternative. Overall convenience. It accomplishes precisely what its name implies. It safeguards your mortgage. It is typically straightforward to obtain, and anyone can purchase a coverage without a medical evaluation. Cons: your mortgage lender, not your family, is the benefit. Therefore, if you pass away, the remaining sum of your mortgage will be paid, but your loved ones will receive absolutely nothing. This type of coverage ties your loved ones into paying off the mortgage and the mortgage alone, even if there are other debts or requirements that are more essential. Although your monthly payments remain the same for the duration of the policy, the insurance's value will decrease alongside your mortgage balance over time. Mortgage protection insurance inexpensive for an insurance type with diminishing advantages over time. The benefits and cons of mortgage life insurance. A normal life insurance policy, such as term life insurance, is an alternative to mortgage protection insurance that allows you to purchase enough coverage to fulfill all of your family's requirements, not just mortgage protection. There are further types of permanent mortgage life insurance policies, but they are typically more expensive than mortgage protection insurance and term life insurance. In addition, they include a number of intricacies that are needlessly confusing for the average person seeking a straightforward financial safety net. Consequently, let's examine the advantages and disadvantages of life insurance for a mortgage. Pros: typically, with term life insurance for your mortgage, you can choose the coverage amount and duration. You desire a $500,000 death benefit with level premiums for 30 years. Sure. Want a $250,000 death benefit paid out over 20 years? No problem, as long as your insurance underwriter approves it, of course. You are not bound to the duration of your mortgage. In fact, you can arrange the term to coincide with your largest financial requirement, such as college tuition for your children or huge debts. There is increased value and adaptability. If you pass away prior to the expiration of your term life insurance policy, your beneficiaries, your family, other loved ones, etc., will get a lump sum cash payment. They can use this money for anything their hearts want, including paying monthly expenses, covering any outstanding debt, and obviously paying off the mortgage. You get more bang for your cash. Why? In actuality, the more an insurer knows about your health, the more precisely they can estimate your premium. On the other hand, mortgage protection insurance does not request health information, but you will be charged for the privilege of not supplying it. Cons: because it is riskier to insure a life if you have major pre-existing health conditions, you may be required to pay a higher premium. In general, the younger and healthier someone is, the lower their rates will be. Mortgage protection insurance is more convenient than this sort of insurance. It just isn't. You may wind yourself filling out a few additional documents and even undergoing a medical examination. In conclusion, whether you've just purchased a condo, a co-op, or a four-bedroom house in the suburbs, you should consider purchasing insurance to protect your loved ones from your mortgage and other expenses after your death. If speed and convenience are important to you, or if you have major pre-existing health conditions, mortgage protection insurance has you covered. Keep in mind that this only covers your mortgage, nothing else. If you take this path, you should not let your bank or lender choose the plan. Since the residence theoretically belongs to them until it's paid off, their top goal is to protect themselves. However, if you're more interested in a potentially less expensive option that allows you to support your family with an income stream while simultaneously covering your mortgage, you should consider term life insurance. This type of policy typically provides the majority of the benefits of mortgage protection insurance at a lower cost. It is also more adaptable and gives you greater control. Buying a home is a major undertaking, but preserving it is an even greater one. Your home plays a significant part in your family's financial future because it is a sizable asset that is likely to appreciate in value. It's reassuring to know that your family will not be burdened by credit card debt, student loans, or car payments after you pass away. However, you must also provide for your family's other needs, such as credit card debt, student loans, car payments, and even just enough cash to survive after losing your income. We're all different. So there's no one decision for everyone, but we hope the pros and disadvantages of the two possibilities have helped you in some way. The thoughts mentioned in this post are for informational purposes only and are not meant to serve as particular advice or recommendations. Please like and subscribe.